welcome everybody. Thanks so much for coming tonight. I'm Cindy Nace. I'm the CFA Cleveland Executive Director. If you haven't met me, most of you have. Thank you. Thank you. We're really excited to be at the Botanical Gardens tonight. It's been a crazy couple of weeks in Cleveland. I think everybody's exhausted, so I do appreciate you coming out tonight and enjoying a cocktail, whether you won or lost on Tuesday. It's good to just kind of relax and talk to a great group of people, so thank you. We are really excited to present this fabulous panel. I'm sorry, I know I have my back and forward to a lot of people. So it's an important topic that we all need to talk about and we all need to learn a little bit more about. And first of all, let me go ahead and introduce our esteemed moderators, who many of you know, who have both been great supporters of CFA Cleveland. Both have been on the board. David has been a president also, so we really appreciate you taking the lead on this. So let me introduce David first. David Alt, PNC, Director of Innovation. He's a member of PNC's Asset Management Group, responsible for providing executive-level analysis and research. He serves as the implementation lead for AMG's responsible investment offering. Mr. Alt also helps shape client experiences, including digital, so that advisors have the right tools to be successful. In addition, he strives to maintain a strong culture for innovation. Thanks, David. On to Deborah. Deborah, also a CFA. Sorry, I forgot to say that. That would have been important. They're both CFAs. Deborah's with Boyd Watterson, as many of you know. She's a contributor of ESG content for CFA Institute's curriculum department and is the author of more than 24 articles for CFA Institute's investment risk and performance publication, including Sustainable Investing, Reducing Risk to Create Alpha, and indexes sprout up as green bonds take root. If you don't follow us on social media, please do. You just go to the website. We've got a lot of great content we're putting out every day. A lot of great people. Ben is helping us with that, another great board member, and we're really excited. We've gotten, a lot of new followers, and please look for really good content on all our social media channels. So on to our panel, who we're so excited, and thank both of you for coming to Cleveland. I know it's been a crazy week for everybody, and lots of change going on, good, bad, or ugly. We all have to, look at it and figure out how we're going to move forward. So let me introduce both of you. So I'm going to start with Abder, Senior Vice President and Senior Investment Strategist for FlexShares Northern Trust. Prior to being named Senior Investment Strategist, Abder worked in portfolio research for Northern Trust Wealth Management Group, focusing on factor-based research, portfolio construction, design, and manager selection. And prior to joining Northern Trust, Abder was the Riley Professor of Physics at Colorado College. So lots of different things, really impressive. Julia, thanks for coming in. Julia's with MSCI, Senior Analyst, ESG Ratings Research. She is a Senior Research Analyst at MSCI, providing research on the social and environmental risks and opportunities of global healthcare companies based in Boston, Massachusetts. Julia leads research for biopharma as well as select consumer industries. She was a lead analyst on the Access to Medicine Index 2010 and a key advisor to the Access to Medicine Index 2012. So thank you for being here. And I'm going to turn it over to David.
Thank you, Cindy, and thanks everyone for being here. Before we begin, I just have some opening comments to ensure that I get a chance to talk tonight. Because otherwise, who knows what will happen. While nobody will mistake me for a millennial, I am the youngest of four, and I like to be the center of attention. Actually, as moderators, Deb and I intend to showcase our two wonderful panelists here tonight, and we'll do our best to serve the interests of the audience first and foremost. And so let me get to my prepared remarks out of the way, and we can get this started. We are all creatures of habit. Advisors, analysts, portfolio managers are not immune to this type of behavior. It often takes us a while to change the way we do things. Sometimes it's for good reasons. Maybe the new thing is just a fad that will fall out of favor quickly, or maybe it's perceived as a marketing gimmick to fool the masses. But other times, something comes along that truly does change the fundamentals of the game, in our case, the investing landscape. Think about how almost everyone discounted robo-advising or the impact of robo or digital advising. Now that the big players are involved, like BlackRock, Fidelity, Vanguard, and assets are flown in their direction, people are taking it more seriously. Unfortunately, it's often only when something is framed as a threat instead of an opportunity that we act accordingly. This reaction often ties into the fear of missing out, which I'm sure we can all relate to. When it comes to environmental, social, and governance investing, or ESG, or whatever term you want to use, responsible investing, sustainable investing, SRI, there are valid concerns about what it means, how it performs, and how it's marketed, among other aspects that cause many in our industry, including myself at times, to be skeptical. And at the same time, however, there are misconceptions and biases that need to be addressed if we are ever going to change our thinking about this type of investing. And recognizing the value of ESG to our profession, I believe that addressing these issues is a must. So even if nothing can convince you that ESG is a viable strategy, your clients may want to align their investments with their values or seek value through these approaches. And ultimately, client preferences should be a top priority regardless of what an advisor's personal philosophy is. And I tell people this all the time. Many asset managers already take ESG factors into consideration when making investment decisions, but others are still trying to determine whether it makes sense or adds value. According to a recent study by Deutsche Bank Asset Management and the University of Hamburg in Germany, close to $60 trillion in assets under management, or about 50% of the total global institutional base, are currently managed by Principle for Responsible Investment signatories. And this clearly demonstrates the commitment the financial markets have toward ESG criteria with investment decisions. But they go on to say that far-reaching shifts of mainstream investors toward embracing sustainable investment practices remains rather slow. In addition, the study indicated that less than a quarter of the investment professionals consider extra financial information frequently in their investment decision-making as of the end of 2015, and just 10% of the global professionals receive formal training on how to consider ESG criteria in investment analysis. So I think all that sets the table for a thoughtful panel discussion. So tonight we're going to clarify what various responsible investing terms mean with a focus on ESG. We're going to address various approaches to ESG investing. We'll tackle some challenges of pursuing this kind of investing, and also touch on some recent developments in this area. And then finally, we're going to open it up to questions. And there's two ways you can do that. There are, I think, note cards and pens on the table. You can write out your question, and Cindy will collect those, or there's a microphone that you can step up to the front of or in the middle of the room. Either way is fine. We're probably going to try to get through the panel discussion as quickly as possible, and then open it up to Q&A at the end. But if you have a burning question during the panel discussion, feel free to add that. So although Deb and I are co-moderating this event, please know that we are not representing our respective employers. That's why we're over here. But our two panelists, Julia of MSCI and Abdur of FlexShares, are representing their firms. And I would like to thank all three of them for their participation tonight. So why don't we get started? Abdur, can you talk about what environmental, social, and governance investing is, or ESG investing is to you?
Me personally, or
however however you want. There's only two rules: are no tribe jokes and no Trump jokes tonight.
Okay,
so.
there you go. There you go. it's funny, we've been discussing this for quite some time. At Northern FlexShares, we've been looking at environmental, social, and governance investing for a number of years. And what we find is that there's a unique link between environmental, social, and governance investing and just, I would say, traditional investing. As you think about financial analysis, you think about sort of looking at valuations, et cetera. But there's something intrinsic about when you look at a firm and get a sense of how does the governance structure work? Does the governance structure work to inhibit shareholders' rights? Does it work to mitigate legal or any type of regulatory risk? Does it work to address social responsibility goals? I'm reminded of a story that I was talking to someone actually from Cincinnati, and if you're from Ohio, you know Cincinnati has a very large P&G presence down there. And every year, they actually have a massive parade or picnic or something, a carnival, for the retirees of PNC, thus impacting community in a very positive way, okay, staying tethered to the community. That sort of talks about where social piece. And also, you look at sort of, if you go to Rochester, New York, Kodak, et cetera, a lot of things that hit those areas are really regulatory issues around sort of dumping, et cetera. And so these are systemic risks that you find in multiple firms at different levels. You can have sort of sector types. Apple really doesn't have any type of environmental risk unless you look at their servers, et cetera. And so you find these different types of things that happen, but they all fit into how a firm is governed and how a firm actually operates and its impact on shareholder value. So when I think about environmental, social, and governance investing, I translate that to the overall impact on shareholder value creation, which is really what we're in the business of actually creating shareholder value for our clients.
Julia, do you have anything to add?
All that. Yeah, thank you, and hello, everyone. I think we're truly at a turning point in the ESG investing space where asset managers and asset owners are thinking about considering ESG factors as a risk and return assessment, regardless of moral considerations. And just from an ESG investing landscape, we've come quite a ways. And I think from an MSCI perspective, we tend to bucket it into essentially three buckets. And the first is a very risk-oriented perspective, and most of our products are actually powered by our ESG ratings product, which is very focused on material key issues based on industries. The second is more of an impact-focused approach, which is where you're looking at returns alongside measurable social and environmental benefits. So that's the second one. And the third one is really a values-based approach. So what we're thinking there is, that if investors want to screen out tobacco companies, gambling, alcohol, and that's not necessarily aligned with returns. So that's kind of how we think about the ESG investing space and how we break it down.
Great, thank you. Abdur, going back to you, as far as the difference between ESG and then the ESG integration, I think a lot of people confuse those terms. Can you clarify that for us?
Yes.
Appreciate it.
Well, I mean, it's always when you clarify, you try to get to it. But when I think of ESG, I think about sort of like an umbrella. And you have different type of investment activities that fall under that ESG umbrella. One is ESG integration. And sort of as I alluded to earlier, it's a way of integrating ESG factors and or behaviors into the total overall investment process. And a quick example about that, if I look at a firm, I can say, I'm going to look at valuations. I'm going to look at price to book, very simple valuation. But also I want to get a sense of how much environmental risk does the firm have. Because as a shareholder, more environmental risk means less money that goes to investment. And this actually happens on the bond side and the equity side as well. Because bondholders want investment to flow back into capital because that's where their value typically intrinsically is. And so if all that capital has to flow out for, say, regulatory requirements and or legal issues related to, say, environmental spills, that's typically the easiest one to identify. Environmental spills, then that reduces shareholder value, increases my risk as a shareholder. So in part, as an investor, I should expect higher expected return for being in that firm. And so those are some of the things when I think about it, how I try to think about it from a ESG is that broader umbrella. ESG integration is one of the sleeves that fall under as a way for investors to access that broader ESG umbrella.
Great, thanks, Abdur. Julia, how is socially responsible investing, or SRI, different from ESG?
ESG integration or ESG
Or either
investing?
one. You can-
I mean, SRI traditionally was really just an exclusionary approach, and now what we're seeing is much more, like I said earlier, a risk-based approach. But in terms of ESG integration, I would certainly agree with you. It's really just a systematic, mechanistic evaluation of ESG factors within, basic platforms, so FactSet, BARA, and it doesn't mean that we're, it doesn't matter what actually happens. So say you are looking at CCC companies and, you tend to, you don't actually exclude them from your holdings. Just the fact that it's being actually considered in a systematic way would be considered ESG integration for us.
Great. Now, we're not here to talk about impact investing, but I just want to add that a lot of people, obviously BlackRock uses that moniker as their catch-all. Other firms use ESG. PNC, we use responsible investment. Others use sustainable investment. We're going to focus tonight mostly on ESG, but realizing that it has a broad, it's an umbrella term as well, as you mentioned. I know we already kind of touched on this, but the distinction between value and values, and can it be both? Do you guys want to touch on that? Can ESG is a value related to values or value, and it can be both? That was one of the questions.
I say 100%.
Absolutely. Yeah.
It's funny because we had a great conversation as we prepared for the panel. We had, I think, 9 or 10 sort of calls. It was about 9 or 10 calls,
At least.
At least 9 or 10 calls to prep for this. And what we
did it during work time, so.
And it's a persistent question that comes up. Can I get value from it as a holder of the equity or whatever the case, or the fund, and address my values? And the response is actually yes. Yes, it can. And so, but it really depends on how you're ascertaining, not your value metrics, because I think I can go across the room and we can probably get consensus on several different valuation metrics to look at it, and if I'm imparting value. But the question is, what do I value as an ESG investor? And can I marry those two together? And we see that in integrative approach. We see it in impact investing. We see it in even SRI type investing, where you might have a targeted exposure to a very specific sector, and you can't see outsized returns. And I think what we'll talk about later is sort of how those different things work, but I think certainly you should be able to, and I'm reminded of when investors really start looking at ESG or SRI type of investments, and there was a sacrifice of return. And I was talking to a colleague, I said, well, at this point, investors have put to us to generate value and value. And we find that over time, investors are no longer satisfied with just value. They've put to the investment professionals, now get us both. And we see that there is a possibility actually to generate both of those and actually improve client outcomes.
Okay. We're going to move on to the approaches section.
Right, so in addition to the confusion surrounding the terms in the space, there's oftentimes confusion in the approaches. So generally under the ESG investing umbrella type, we find maybe 4 categories of approaches: negative screening, positive or best-in-class screening, ESG integration, and impact investing. So maybe the two of you can walk us through those approaches and some of the more recent developments in them. I know Julia, MSCI, does quite a bit with the best-in-class and screening and impact investing.
Yeah, so I'll just say one thing in terms of the impact investing. What we call it is actually sustainable impact, and we want to just be very, very careful with that language, because what impact investing has traditionally obviously been associated with the private equity space, but what we're really trying to do with sustainable impact is solve that size and liquidity challenge. So we have a very distinct approach where we look at companies 50% revenue threshold in terms of what types of activities they're operating in, whether it's clean tech, major diseases, and all these things essentially are aligned with the UN Sustainable Development Goals. And we did a very extensive client consultation to see exactly what that would look like. And the feedback consistently was that if you look at impact, you want something measurable, you want something long-term, look at this Sustainable Development Goal. So that's one of the key approaches that we're taking. And in terms of exclusionary, yes, we obviously have quite a bit of screening activity, but really the flagship product is the ESG ratings risk product. And I don't know if we'll talk about that now or if we want to kind of go into the weeds a little bit about that. Okay. So the ESG ratings product, there's a couple things to know. And the first is that it's materiality focused, right? So every company that you look at has a very, very different risk exposure profile. And they also have different combinations of key issues that are underlying those assessments. So it's really, it's gap analysis based, so it's not tallying based. We're not saying, okay, well, X company is doing this, so that gets 1 point, company B is doing X plus C, so that gets 2 points. And I think what's really important about that is that it really helps to dampen that disclosure bias that you often get with a lot of ESG data. So it's a best-in-class approach, and we're not actually saying, okay, well, tobacco companies, let's just get rid of those. It's very industry-specific focused, and I rate the tobacco companies, so I get a lot of questions about it. What else did we want to impact investing? ESG integration, screening. I think we all know what that is.
Right.
And then positive versus negative screening. I would think it's just it's an objective. It's what your main goal is, right? So positive screening, you're looking at returns more, I would say, and then negative screening, you're really exclusionary focused in terms of your approach.
And then in terms of portfolio construction, sometimes a combination of methods are used. And Abdur, can you talk a bit about some of the methodologies behind the ESG ETFs that you have recently launched at Northern Trust?
Yes, thank you. Some of the things we've actually worked on with our ESG ETFs is thinking about the factors that might impact risk or return. And so we tend to take a very factor-based approach to our product development, product design, and by taking that approach, we're able to leverage a unique event that happened around 2005. Around 2005, you saw a proliferation of ESG disclosure data by companies. And so this disclosure data is fairly rich. And I'll emphasize, it's not data mining. And so we try to actually step away from data mining to see, is there anything real in the data that we're actually seeing from a risk-return perspective? And so as these disclosures start to really resolve themselves, a simple disclosure could be, say, the percent of women on the board. And the question is that, does the percent of women on the board impact shareholder value? Yes or no? And we're agnostic about if it does, or we like to see it impact shareholder value, but we're agnostic about the disclosures that we look at. So we look at the entire body of disclosures, and we try to get a sense, does it reduce risk? Does it increase risk? Does it impact return, increase or decrease impact, the impact on return? And by looking at those, we get an idea of which ones are material to shareholder value creation. Now, we look at them in 3 different buckets: governance, environmental, social, and governance. And I will say, in full disclosure, that typically governance will overhang it really will overhang. And the reason that is that when you look at governance structures in place, typically good governance will have good environmental and social policies in place as well. Those will typically be drivers. And so when you talk about environmental, social, and governance investing, a lot of it really will hang off of governance. And so when we do the integrative approach, by looking at governance, we specifically look at a few things. One is the impact on shareholders' rights. Around 1980, mid-80s or so, what you saw a lot of activist investors. And then you saw a huge proliferation of firms that were starting to be incorporated in Delaware. Because Delaware, you saw a lot of legal structures in place to inhibit shareholders' rights. proxy fights were minimized. But when you did a look through the portfolio, you found that that limitation of shareholders' rights also led to a lot more mismanagement of the firm, led to, say, WorldCom. All right, and so those are typically fraud events. And so by looking at those, you get an idea of how do those individual factors around percent of women on board, percent of owners necessary to actually call a special meeting, percent of independent board members, all these things that are resolved within the financial statements, and that's what we really want to leverage. We want to leverage data that was independent from any type of data aggregator. So we wanted to find exactly which ones would actually be involved in the process by looking at the data that was out there. So by looking holistically, we could sync that with some of the other metrics we were using around price to book, price to value, quality, cash flows, et cetera, and get a very holistic view of what the firm's performance will look like through an entire holistic lens.
And so you talked a bit about governance, and that reminds me of Volkswagen. And that also reminds me of MSCI's ratings on Volkswagen before the scandal. So Julia, do you want to maybe walk us through the Volkswagen example?
Sure. Yeah,
Why
sure.
MSCI had a very low rating on Volkswagen before.
So I mean, there are a couple companies that always come up, right? So it was BP in 2010, which was excluded from our MSCI ESG index. And then BP, VW, and then a couple after that, Valiant and Mylan are the go-to examples, I would say. But in terms of VW, I mean, it was a governance issue, right? So there was a power struggle going on. Ferdinand Peitz from Porsche, resigned as chairman. So that's one of the issues that we were capturing. It also was flagged as aggressive in our accounting and governance risk model, which is really an area where also Valiant for accounting fraud, you mentioned fraud. So that was really something that we looked at closely, and also our was among the lowest rated companies. So Valiant was our CCC, Mylan was a CCC, VW was, I believe, on the lower end, double B, capturing those governance concerns and the product safety and quality. So also excluded from our MSCI ESG indexes. So again, governance really is the overarching theme, and I think we can talk about E and S, but really governance is really the overarching element that ties all of those things together. And I think in terms of our actual ratings models, we have a rating, right? But then when you look at the underlying factors, it's really important to actually differentiate how a company performs on each of those individual pillars and take a really granular look at what those assessments are, rather than just having a high level, top level, okay, this company's a AAA, CCC. So absolutely agree that the governance is the overarching and overriding factor.
That's right, because you can have some companies that have extremely low ratings in some areas, but very high in another, so then they might look fairly decent, but actually have very high risk in certain areas.
Exactly.
And then,
may I add something to that?
Sure.
What's interesting about what Julia mentioned is that the idea around governance, if you talk to any analysts that maybe follow the energy sector, BP's always had issues. If you look at their subcontract, if you look at an analyst report on BP and they start to drill down, you find that BP has always been rated. We always joke in Illinois that the widening plant in Indiana goes out at least once a year. It goes down at least once a year, and then gas spikes for about a month or so, and then it comes back online. And so BP's always had these systemic issues. And so what this approach does, it allows the investor to really now codify what it would take an analyst a long time to actually aggregate together by looking at these individual metrics and actually really coming up with a mosaic picture. But I think at the end of the day, what we're doing as we build these models and think about aggregating the data, we're doing what traditional analysts would have done, I would say 10, 15, 20 years ago when they looked at each individual security. But as we know, as investors in the house, it's very difficult to have an analyst team large enough to look at the whole body of every security or every sort of industry. If it can be codified in a way in which, as Julia's talking about, it allows a streamlining of the process and also allows fee compression as well. So.
All right, so Historically, ESG has been first applied to equities, and that I think is where the largest AUM is right now. But it's also been adopted into fixed income recently and other asset classes. Can you elaborate a bit on that? Like, what are the challenges of looking at ESG factors in fixed income or private equity or real estate?
I mean, so on the fixed income side, you know, there's a study that just came out, Barclays, which was really a great study, and I would recommend that those of you who haven't read it should maybe take a look if you're interested in that field. But it essentially shows that the fixed income space does seem to be quite well aligned with ESG, and you know, broke down portfolios, a high-performing ESG portfolio versus a low-performing portfolio, and they differentiated the different factors. And what was interesting about this study was that it actually took our data and a competitor's data and found that there was outperformance based on two very different methodologies, right? So MSCI and our competitor, we have quite different methodologies. The factors were a little different, and the outperformance signals were a little different, but the overarching thing, again, was governance. And that's also an interesting area, too, because a lot of investors in that space, there seems to be a disconnect or perhaps a mismatch in terms of which factors are actually more important. And in that sense, the governance was most important to the manager, but then environmental issues were more important to the asset owner. So, you know, you get a lot of disconnect, and I think that actually just speaks to the complexity of this space where, again, it's the conversation values versus value, right? And this is an example where you can find some overlap, but I'll let you comment a bit more.
Yeah, we've actually looked at too, and actually I'm reminded of a paper that was written by a friend named Amir Sufi. He's a professor at the University of Chicago in the economics department. And so where he looked at governance from a bondholder's perspective. And there was a really unique correlation in covenant violations. If you're familiar with sort of covenants that bondholders have. And bondholders are fairly unique, but because they have so much more information than equity holders do. You know, it's like when you apply for a credit card, they get more information for you to get for the credit card because they're a creditor. And so what they found is that they found that these covenant violations were very much uniquely tied to management changes. And so what would happen is that if there was covenant violation, liquidity constraints were now put in place by the bondholders almost immediately. And within maybe 12 months or so, management would change. So governance would change. And so CEOs are actually losing their jobs when these violations happen. Costs were reined in as well. And so you saw this sort of ripple effect when these covenant violations were happening. And it was unique about the article is that it showed that there's a connectivity between bondholders and equity holders, because well-governed firms will manage liquidity, they'll manage debt ratios as well, and they'll manage sort of debt to liability ratios to the point where bondholders' covenants are still satisfied and you still have upside without having to actually reduce the investment part of, or say, return earnings as well. And so it's interesting that there is a very tangible impact on governance from not just the equity holder, but also from the bondholder. I think I lost my mic. Did I drop the mic?
No, I think it's still working.
Right, thank you. We're just cutting you off. No. I see. I'm kidding. Julia, do you want to talk a little bit about the fund ratings that MSCI has available?
Sure. So we were actually just talking about this earlier. So I'm assuming a couple people saw the FT article, and there's other research out there. But so before I get into that, I just want to say the progression for the ESG investing space is, it's gone from exclusionary, then it's gone to impact, and now it's going into the what do you own category. And for us, the fund metrics, which is the rating of the mutual funds, it's really about transparency, and it's really about figuring out what are your goals. And we try to very much stay away from just giving one signal, because we think that's a very, very dangerous way to look at it. We don't want to categorize above average, below average, because when we actually break it apart and we look at 10 different funds, those funds look very different based on very different factors. So the values angle, the risk factor, and the impact factor. So again, it's getting to that point where you really, really have to drill down. And you know, it's really a goals-based exercise. So what are you hoping to achieve? And that's what it's about. And the drivers, of course, are this massive wealth transfer. I think there was something, facts that came out with a stat that was 90% of millennials want to allocate more to ESG factors within the next 5 years. So you have this massive transfer of wealth, and you know, millennials want to know what they're owning. So it's really a tool for engagement. It's a tool to start a conversation to say, okay, well, what does my portfolio actually look like along these 3 dimensions? And that's, I think, what we're really trying to achieve with that, is just that dialogue and that transparency in terms of goals.
For the people who don't know about the Financial Times article, can you summarize that quickly?
Yeah, to be honest, I just glanced at it very, very quickly. But essentially what it was saying was that Morningstar came out with these ratings, and it was saying how, you know, based on some data, and that the funds were categorized into above average, average, and there was a lot of, you know, just criticism about the fact that how can you boil down a mutual fund into just one type of above average, and what actually goes into that scoring process. So that's the gist of it.
Yeah, and many dedicated funds were getting low ratings, and since it was so, I think, one-dimensional, unlike MSCI, which I'm not plugging MSCI, I happen to, but with the MSCI ratings, you can actually get much more granular into what the fund is, whereas the Morningstar rating, it's just a five globe rating system. So I think that was part of the criticism, that some of the dedicated funds were getting low ratings, but the managers of those funds were pushing back, saying that the Morningstar rating really wasn't getting it right. And that's all I had to say about that.
Right. Some of the conventional mutual funds were getting higher ratings than the ESG or ethics-oriented funds that they were scoring.
Yeah, and I mean, just to that point, I'll just say one thing. When they, you know, we have a very simplistic presentation of it, the risk, values, impact along those 3 dimensions, but there's 100+ data points that are underlying that, and underlying that is a lot of other data points. So these are all powered by products where analysts, you know, we have a team of 150 research analysts, so we are not, it's not a high level, it's from the ground up, but what you're seeing is the top level, the high level.